Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the confusing world of corporate filings, and today we've got a real gem. Get ready because we're diving into Flywheel Advanced Technology Inc.'s latest report. It is packed with more twists and turns than a roller coaster. And we're going to unpack what it all means for any investor trying to keep up. Before we get into the nitty-gritty, if you love uncovering the stories hidden within these financial documents, make sure you are subscribed. And hey, we've got a fantastic community over on our Discord server, link down below in the description where you can chat about these filings and so much more. Alright, let's cut to the chase. This is Flywheel Advanced Technology Inc.'s quarterly report, specifically for the period ending the 31st of December 2025. Now, this company has had quite the journey, and it states here it is a smaller reporting company, meaning it is not subject to as many disclosure requirements as larger players. They're also confirming they've filed all their reports for the past year. That's good housekeeping. And check this out, they've submitted electronically every interactive data file required, which is a big deal for transparency. The report itself, a Form 10-Q, gives us a look at their financial health for the quarter. One of the first things that jumps out is they are a shell company as of this filing. This doesn't mean they're shady, but it means they have nominal assets and really no significant operations right now. Their main goal for the next year is to find a business to combine with or to build an operating business. Right now, they haven't found that perfect match yet, and they have a lot of freedom in looking for opportunities, which could mean anything from mergers to joint ventures. Digging into their financial statements, we see the company's name is Flywheel Advanced Technology Incorporated, formerly known as Pan Global Corp. They were incorporated way back in 2010 in Nevada. The report outlines a bunch of historical events like a stock purchase agreement in 2021 where a new controlling shareholder came in, a name change in 2021. And a reverse stock split in 2022. They also mentioned preferred stock issuances and the formation of subsidiaries like Blueprint Global Incorporated. It's a lot of corporate maneuvering, which is pretty common for companies trying to restructure or prepare for growth. Now, let's get to the numbers because that's where the real story often lies. Looking at the condensed balance sheets, which basically show what a company owns and owes at a specific point in time, we see for the 31st of December 2025, their total assets are only $7,254. That is incredibly small, especially when compared to their liabilities, which are over $984,000. This huge gap shows they have a very significant negative stockholders' equity, a deficit of nearly $977,000. This means, on paper, they owe far more than they own. Specifically, their cash and cash equivalents, which is the money they have readily available, is a mere $3,500 as of the 31st of December 2025. Compare that to their liabilities, like $952,627 owed to a related party, and you can see the financial pressure they're under. This is a classic sign of a company in a transitional phase, relying heavily on external funding or related party advances. Moving to the statements of operations and comprehensive loss, which tells us about their profitability over a period, things are pretty stark. For the 3 months ending the 31st of December 2025, their revenue is zero, absolutely zero, and their operating expenses, mostly professional fees like legal and advisory services, came in at nearly $46,000. This resulted in an operating loss of the same amount. So for this 3-month period in 2025, their net loss was $45,997. This is up from a loss of $26,713 in the same period of 2024. The increase in losses is largely attributed to those rising professional fees, which makes sense if they are actively pursuing new ventures or dealing with regulatory filings. The earnings per share is listed as zero for both periods, which is consistent with having no revenue and a net loss. When we look at the statement of changes in stockholders' equity, the accumulated deficit tells a similar story. As of the 31st of December 2025, their accumulated deficit is over $10 million. That is a lot of red ink built up over time. This means that over its history, the company has spent more money than it has earned. The cash flow statement reveals how cash moved in and out of the company. For the 3 months ending the 31st of December 2025, they used $42,785 in operating activities, meaning their core business operations, even without revenue, are burning cash. There were no investing activities, which is typical for a company in this stage. But they received $46,285 in cash from financing activities, which primarily came from advances from a related party. This inflow of cash from financing is what allowed them to have that $3,500 cash balance at the end of the period. So essentially, they are being funded by loans or advances from associated entities to cover their operating expenses. The notes to the financial statements are crucial for understanding the context. Note 1 gives us a detailed history, including the formation of Blueprint Global Incorporated and the acquisition of QBS System Limited. It also mentions the sale of subsidiaries like QBS System, Pontifides, and Megafortune in July 2024. This sale brought in about $7.2 million in exchange for 938 shares of a subsidiary called Ellison Virtus Company Limited. This transaction is a key reason they are now classified as a shell company, having divested significant operational assets. This leads us to the investment section. Here we see that Ellison Virtus Company Limited is listed as a cost method investment. However, the crucial detail is that this investment was fully impaired as of the 30th of September 2025. This means the company believed the investment was worth $5,422,500. But due to uncertainties and lack of observable inputs, they had to write off its entire value. Effectively, this investment is now worthless on their books. And here is a big one: related party transactions. As of the 31st of December 2025, Flywheel Advanced Technology Inc. owed over $952,000 to Flywheel Financial Strategy Hong Kong Company Limited. This is for advances that are repayable on demand and don't carry any interest. This means a significant chunk of their current liabilities is owed to an entity closely connected to the company, which is a common way for early stage or restructuring companies to secure funding, but it also highlights their reliance on these related parties. Now, let's look at the management's discussion. They confirmed they had no revenue for the periods discussed. The increase in operating expenses, primarily professional fees, is acknowledged. They state that the cash on hand, combined with financing, should be enough for the next 12 months. They also have a dedicated section on being a shell company, emphasizing their lack of operations, and that their main focus is on finding a business to combine with. They're not looking to develop a market for their current securities until a successful business combination happens. Getting back to the results, management confirms no revenue for the 3 months ending the 31st of December 2025 and 2024. The professional fees are a significant expense, and the net loss increased in 2025 compared to 2024, mainly because of these higher advisory costs. Under liquidity, they reiterate the small cash balance. The cash used in operating activities decreased year over year, which is good, but still negative. The financing activities show that advances from related parties are their lifeline. Management believes they have enough cash to operate for the next year, but this is heavily dependent on those continued advances and their ability to secure further capital. A very important part of any SEC filing is the section on internal controls. Here, management admits their disclosure controls and procedures were not effective as of the end of the reporting period. They highlight several material weaknesses: a lack of a functioning audit committee, insufficient outside directors for proper oversight, inadequate segregation of duties, and management being dominated by a single individual without adequate compensating controls. This is a significant red flag for investors, while they state these weaknesses did not affect past financial results. They warn that future financial statements could contain material misstatements due to this ineffective oversight. On the legal front, they state they are not involved in any pending legal proceedings that would likely have a material adverse effect. That's a positive note amidst the financial challenges. Finally, the exhibits include certifications required by the Sarbanes-Oxley Act confirming the accuracy of the financial information, and the inline XBRL documents, which are essentially the machine-readable version of the report. Okay, so here is the deal with Flywheel Advanced Technology Inc. based on this filing. This is a company in a major transition, operating as a shell company with very minimal assets and no revenue. Their financial health appears precarious, with a huge accumulated deficit and a heavy reliance on related party advances. The management acknowledges significant weaknesses in their internal controls, which raises concerns about future financial reporting accuracy and corporate governance. The big question is, what is next? They're actively seeking a business combination. This is where potential upside lies, but also significant risk. If they find a promising target and execute a successful merger or acquisition, the value of their stock could increase dramatically. However, the path to finding that opportunity is fraught with challenges. They face intense competition from other companies looking for similar deals, and their current financial situation limits their negotiating power and operational flexibility. The impairment of their investment in Ellison Virtus Company Limited is a clear sign that past ventures haven't panned out as hoped, and the substantial debt owed to a related party highlights their ongoing need for capital. Without a successful business combination, the company's future as a going concern is uncertain. In essence, Flywheel Advanced Technology Inc. is a speculative play right now. Investors would be betting on management's ability to find and successfully integrate a new business, transforming the company from a shell into a revenue generating entity. The lack of effective internal controls is a serious concern that needs to be addressed. Alright, that is our breakdown of Flywheel Advanced Technology Inc. Its latest filing, what is your take on these numbers and what they signal for the company's future? Do you think they can pull off a successful business combination? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and make sure you subscribe for more deep dives into the corporate world. And don't forget to check out the Discord community linked in the description. It is a great place to connect with fellow analysts and share your insights. Thanks for watching, and we'll see you next time on Corporate Decoder.